Investment is run by a bunch of investment bankers, and their modus operandi.
Hello, I'm Javier Sáenz de Cenzano from Morningstar. Today we are going to be talking about high-yield investments, an area of particular interest these days given the low interest rate environment we are going through. To talk about this, we got GregHopper, who is head of global high yield at Aberdeen, company he joined in 2013 when RTO Global Investors was acquired by Aberdeen. Greg also runs the Aberdeen Global High Yield Bond Fund. So Greg, thanks for joining us today.
Thank you for having me.
The first question, given that your expertise is on high yield, is going to be basically if you think high yield investments is now an attractive area in the market.
Of course. I believe that broadly speaking, high yield from a global basis is probably about fairly valued, especially in the US and in Europe. But within that fair valuation, there are still a lot of opportunities, a lot of pockets of undervaluation to be exploited. And we also believe that there are some very good values in the emerging markets. One other point I'd make in terms of overall valuation, I'm emphasizing that it's fairly valued, not overvalued. A lot of investors are concerned about the effects of rising rates on the valuations of high yield, and we believe that high yield really is all about credit risk. If we want to be concerned about the valuations, we have to be concerned about the prospect for the credit environment, which in a recovering economy I think is positive, not negative.
And within high yield, you mentioned emerging markets as being especially attractive.
Yes.
So why compared to the developed world? And within the developed world, do you find any areas that you would see more attractive?
Yeah. Well, in regards to the emerging markets, it's a very broad and diverse set of issuers, as you can imagine, in the emerging markets. On average, emerging market securities are yielding close to what you would get in triple C's in Europe and the US. And yet many of these issuers are actually very high quality, more like double B type of issuers, and have been thrown out, as we say in English, babies with the bathwater in a way. They're actually good credits, but they're being tainted by the fact that they are in the emerging markets when people are so concerned about events in places like the Ukraine and Russia, or macroeconomic events in South Africa, or political events in Turkey. Meanwhile, there's some very good and robust corporates in places like Mexico and Peru and Indonesia that we think are undervalued. In terms of the developed markets, even though on average, from a broad standpoint, valuations are more or less fair at this point, there are pockets of opportunity. Two that I would point to are long 30-year double B bonds where we are constructive on the credit and even maybe expect the credit to eventually become an investment grade bond. Your upside in terms of what could happen in a credit improvement versus your potential downside is very skewed, I think, positively towards the investor. Another example of value in the developed world is in senior secured credits of companies that are coming out of bankruptcy, where they still may be suffering a little bit from the taint of having been bankrupt, but they're actually been reorganized. There are stronger companies. There are also sometimes some technicals as they come out of bankruptcy around these more senior securities. We think you can get some very good values there.
Okay, so more generally in terms of your investment process, I see that you combine kind of top-down views with more bond-specific stuff. Can you briefly let us know what's your investment process for this fund?
First and foremost, our process is very bottom-up, very credit research-based. We build the portfolios issue by issue. Secondly, it is very the risk management is really almost part of the investment process, and in several instances is very explicitly part of the investment process. And then thirdly, we create a very broad opportunity set for ourselves. We diversify not only across geographies, but up and down the capital structure. We're willing to buy more senior secured bonds. We're willing to go into convertible bonds. We're willing to go into the distressed world. We're willing to go into the borderline investment grade world of triple Bs. That gives us the flexibility to, dodge areas of overvaluation, exploit areas of undervaluation.
Okay, and you mentioned bottom-up, like bond picking, as being a
Yes.
key component of the process. Maybe you can give us a hint on how you select the bonds or issuers.
Yeah, I think it's fair to say that every high-yield manager is probably going to come and say, it's all about credit, it's all about credit, it's all about credit. So then one has to ask just the question you just asked. So if it's all about credit, exactly how do you do that credit? At Aberdeen, we analyze every company, we talk to the management, we create models, we create forecasts, we talk to other analysts, all of which many other high-yield managers will do. We take it a step further still, and we make an effort to actually talk to people that are in the industry that may not necessarily be at the company or in finance, to get a sense of really what are the business economics of the industry we're looking at, what might be changing in the industry, how are the issuers that we're interested in might be changing, and therefore might they be better or worse credits going forward based on this, what I would call business economics-based credit research.
Okay, that's very interesting, Greg. Thanks a lot for joining us today.
Yeah, thank you for having me. Appreciate it.
And thank you all for watching. Please follow us on our Twitter and Facebook accounts. Thank you.
Is run by amazing investment bankers, and their modus operandi